This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Douglas French with us this morning, most recognizable as a Casey Research contributor. Welcome, Doug.
Thank you, Gordon. Pleasure to be with you.
Oh, it's our pleasure. Doug, maybe we could begin by you giving our listeners just a brief overview of your background, the kinds of things you're involved with.
Well, as you mentioned, I write for Casey Research. I also teach money and banking down the road at Troy University, and which is interesting because I spent 20 years in the banking business in Las Vegas. Prior to that, I actually studied under, hopefully someone your listeners will recognize, Murray Rothbard.
Oh, yeah.
Who was a great libertarian and great hard money advocate. I studied under him and wrote my thesis under him at UNLV. So, interestingly enough, I wrote a thesis about speculative bubbles and busts, and then I participated in one of the biggest bubbles and busts with Las Vegas real estate, and then I came to Auburn to run the Ludwig von Mises Institute, and now I write for Casey and other publications.
Interesting background, an Austrian background mixed well with a real true speculative bubble. But being a banker in Vegas, that's interesting. Well,
it certainly was interesting, and well, let's just say I've had plenty of stories to tell my students this semester, and there's nothing like being on the ground. It's very easy to speculate and second guess people about bubbles. How could you do that when you're sitting in the ivory tower? But it's a lot different when you're on the ground and seeing the bubble from inside out.
Are we in a bubble right now?
You know, interestingly enough, I think about that a lot. I think the biggest bubble we have probably is in U.S. treasuries. And the idea that you could never get hurt by being in a particular asset is a quality that we always see in an asset that's in a bubble. And probably the primary asset that we have now that nobody thinks they could ever get hurt in right now is U.S. treasuries. And certainly with these yields, to the idea of lending an entity that is 17 trillion going on 18 trillion and beyond in debt, they'll never be able to pay that back. The idea that you only get 2.5% for 10 years for that kind of risk, I think it's referred to as return-free risk. That's certainly bubble territory.
That it's considered risk-free, and those kind of returns, that's nominal, of course, and in real terms. The risk to me, is not the default. The risk to me is in the currency.
Sure.
And that's the fallacy. But we have completely distorted the pricing mechanism today, where risk is not, in my mind, being properly priced in, and time will tell on that. That leads to really the theme of the show here is helping our listeners understand financial repression, a macroprudential strategy. We're hearing Yellen talking about it. We're hearing Stanley Fischer talk about it in a number of their speeches. Doug, could you share with our listeners what you see financial repression to be, or how you understand it?
Well, the way I understand it is essentially this is you have PhDs at the Eccles Building in Washington, D.C., running the Federal Reserve, and their plan is to try to create economic growth with inflation and also keep interest rates low. So the repression is that guys like you and I will probably never be able to retire because we can't get any return on our money. so that we can prop up the government and keep it in business. And this worked to some degree when bank rates by law were held low after World War II. They took the debt to GDP ratio from, say, 100% down to 30%. And it was fairly easy to do. It's not as easy to do in this kind of environment. And it is ripe for error. It is ripe for booms and busts, which we've had. And it's ripe for just liquidity seizures, if nothing else, that I think we need to keep an eye on from quarter to quarter. This idea of repo fails, this idea of guys or institutional money managers scrambling for collateral to complete their repo transactions where there's not enough collateral available because the Federal Reserve has purchased it all, is going to create a problem that probably nobody's even heard about. And that'll likely be the cause of the next crash. And so that's what I see financial repression as, is this overall macro strategy of the government. But central planning's never worked. It's never worked if, it's never worked in communist Russia. It's never worked in Cuba. And it's not going to work at the Federal Reserve. But that's what they're attempting to do right now. They're trying to essentially print their way out of a jam.
You make some really excellent points, Doug, just to confirm what you said, in terms of repos and the next crisis there. Don't ever confuse liquidity with collateral and wealth. And right now, you're seeing repo fails on a regular basis, which is the collateral, frankly, is the collateral on a short-term basis in the shadow banking system. And for those who remember 2008, the crisis really fundamentally started because it's about lending long or lending short and borrowing short and lending long. And so they were using asset-backed commercial paper. Today they're using repos. And so with the Fed having all of the collateral, really, now they've had to start doing reverse repos, about $300 billion as almost a protective strategy. But there's a true collateral problem out there. So liquidity today can only transfer into credit and debt if somebody can post some level of collateral. And whether that's a hard asset or, in fact, whether it's some kind of cash flows. And with rehypothecation, that has been extorted or exaggerated to such an extent. So I fully agree with you. Comments on any of that?
Well, I think you're exactly right. And I think some of this collateral has been pledged, repledged, and pledged and pledged and pledged over. We see it in the gold market where the physical, there's a huge amount of paper gold out there, if you will, that is collateralized by a tiny bit of physical gold. And I think you can see the same thing in the treasury market right now. And I think the average person on the street with their money in a 401k, who's simply trying to put away a few bucks so they can retire one of these days, is going to be extraordinarily shocked by something they never saw coming, because it's hard to explain. Let's face it. It's hard to understand. It's hard to explain. Yeah. But I think you have money managers scrambling for this liquidity. I mean, Keynes, actually, I hate to quote Keynes, but in the general theory, he mentioned investing being a game of snap or musical chairs, where you try to find a chair before the music ends. And I think that's what portfolio managers and money managers are doing every quarter.
Yeah, there's no question about that. It's what I refer to as the indirect exchange, and a lot of the smarter ones are trying to put their money into something that's going to be a true store of value, because since we went to a fiat currency, money no longer is a store of value. You mentioned financial repression after the Second World War. We've already been through this, but we weren't on a fiat-based currency system at the time. And so the distortions that we now have here are much more dramatic. Doug, could you give us some examples of where you're seeing either United States or globally financial repression, where it's obviously or most troubling, or frankly most troubling to you?
One of the pure definitions of repression is, funneling money to the government that should have gone to private hands. And I think that's probably the best example. I can't remember who did that calculation, but it sounds right to me. that almost, more than $750 billion has gone to the benefit of the government that should be in private hands. And I think hopefully most of your listeners would agree, we would like money in private hands. It's used better than going to the benefit of the government. So that's the primary repression that I see.
Well, there's millions of retirees in Florida right now who would say they know that money disappeared somewhere because they had planned their retirement on having 6%, let's say, kind of return on their investment in cash, and now nothing, next to nothing, unless they're willing to take extraordinary risk with that money. And that's part of financial repression, is forcing you to take risk on risk of your assets.
Well, absolutely. And Ben Bernanke as much as said that he wanted people to go out on the risk curve. He was following the Russell 2000 and bragging about QE pumping up the Russell 2000. But, how on earth, even those with a pension, your listeners who are sitting there saying, oh, I'm fine, I've got a pension from XYZ government or XYZ municipality. Well, guess what? They are assuming they're going to make 8.5% on their money to pay their actuarial claims. And most of them are underfunded. And there's no way that, how do you assume 8.5% return in a world where the Fed has tamped down interest rates to virtually zero? I mean, there's no way you can make that assumption unless you are taking extraordinary risk, unless you can guess every bubble correctly and get out before every bust. Because one bust takes you out. One 40% crash undoes your 8.5% in perpetuity, virtually forever. And we have an entire pension system built on this. And if that isn't financial repression, I don't know what is.
Yeah, it's my opinion the next crisis will stem from the pension and insurance industry versus just the banking industry, because there's $3 trillion of unfunded pensions just within the government side, at the state, local levels, and adding in another $1 trillion from corporates that are underfunded, nor can they ever probably reach some kind of funding level in them. Doug, is this a planned strategy, or is this just the nature of an evolution right now? Is the government formally intending on doing this? Is that calculated?
Yeah,
or are they just that naive?
Well, I think it's probably maybe a combination of all of that. I know that the other system or the other way, the other solution to get out of their financial straits that they're in would be to cut back on spending, not only balance the budget, but run surpluses and all these things that they're not going to be able to do. So I think there is the attempt or the thought by the Federal Reserve is that they can consciously do this, that they believe that they can create inflation. They think they can keep interest rates low. They can tell everybody there's no inflation and make the equation work, because they've got an equation that they think that eventually they can bring the debt to GDP down to a manageable level or make it go in the correct direction downward. And so I think it is a conscious effort in that sense. But Hayek said that that's essentially the fatal conceit, the idea that you can any single human or any building full of humans can assume all the factors at play in a marketplace is naive. Not only naive, it's dangerous, and it's very dangerous, and that's the game they're playing. So I think that they are naive, but there's enough hubris in Washington D.C. probably for many lifetimes worth of worlds, and they believe that they can fix this problem with their equations and their models and pushing the right interest rate lever or the right monetary button. So I think it's a conscious effort on their part. I just don't think they'll be successful in any sort of way.
So realistically, there really is no way out of this in their mind and generally, but to continue to expand money and credit and thereby basically debase currency as a store of value. Is that a fair summary?
Yeah. Yes, that's and of course the Paul Krugmans of the world would say guys like you and I are this members of this deflation caucus that not only has the Fed, well, they've kind of done the right thing in Krugman's view, but he believes they haven't done enough, and so. And he says, well, listen, Austrians, look, where's the hyperinflation already? The Fed has quadrupled its balance sheet. You guys said we'd have runaway inflation by now. Where is it?
Well, he obviously doesn't understand what hyperinflation is. Hyperinflation is a currency event,
right?
And that's when people lose confidence in the currency. I've studied 52 examples, and that's exactly what it always is. So it says you don't have hyperinflation until there's a run on the U.S. dollar, if you're in America. But right now, we have a flight to safety to the U.S. dollar, in my mind, around the world. Not necessarily that it's the right place to be, but relatively speaking, which in many ways is inflating U.S.-based asset products right now. But so there's a fear with currencies as they're being debased around the world, already building.
Well, no question. We are the best house on a horrible block, if you will, and what the Fed cannot do is they can't print. They can't print the number of times the dollar turns over in commerce, and that has fallen into to an all-time low. Because people are doing many people are doing the right thing. Sometimes whether they want to or not, maybe they can't get debt from the bank, but there's a tremendous amount of increase in savings. The banks have $2.8 trillion parked at the Fed that's sitting there doing nothing. So there's all kinds of tinder for this hyperinflation fire. But as you say, there's tremendous confidence in the dollar right now, and that may last, who knows, through the rest of our lifetime, or it may last till next week. We don't know, but there'll be a tipping point, and it'll probably be a liquidity event, some kind of crash event that may be that tipping point, and then all the assumptions about the dollar and what the Fed can continue to do are going to be. Are going to completely go away in an instant.
Well, the global economy is approximately $72 trillion. Well, the size of the global shadow banking system is $72 trillion, thereabouts. And what I make as a point, that's all based on short-term lending to finance long-term. And you have any kind of liquidity kinds of issues, which will come from a collateral problem. I call it a margin call. It would be explosive and sudden, and it would cascade down. So it's sitting there, and it's not being addressed. It's not being controlled by regulators, and you've got a $700 trillion swaps marketplace hidden behind that. That doesn't take much kind of adjustments or realignments of fear, either in currencies or interest rates, to cause a lot of havoc. I don't mean to frighten people, but those are the realities. You see those same things, Doug?
Absolutely. And a lot of commentators will say, well, listen, you guys are overstating this because you should net out, some of the, if you're the same guy is long with the same counterparty and is short, you net those out so the net exposure isn't near as big. But, that's a fallacy. Listen, I've sit through salesmen selling derivative products, and they don't pay any attention or talk about the risk of counterparty risk at all. It's like every counterparty is solid gold, and not every counterparty is solid gold, as we found out with Lehman Brothers and others in 2008. So suddenly, what we think of as big, huge, powerful financial machines out there are brought to their knees in a hurry, and there is all kinds of counterparty risk out there that's not being accounted for.
And in a world that's so complex and so interconnected now on a global basis, all operating on fiat currencies, it doesn't take too many players or one player to start a tremendous and automatic cascading effect. It, frankly, once it begins, there aren't the mechanisms anymore to even try and figure out how to control it. We were lucky in 2008 that it was primarily something in the United States where the Federal Reserve could act quickly with the various kinds of programs that came out to stop it. But on a global basis, a whole different story. Now, if this is the case, how do investors protect themselves? And as importantly, like, how do they take advantage of this investment opportunity? Because it is an investment opportunity if you understand the problem.
Well, every crisis, creates an opportunity, and I think as we've talked about, if you have invested in something in paper, there is someone standing behind that paper, and what we're questioning is how much strength is behind that paper. And for my money, I think there's nothing like real assets that have been around for generation after generation after generation. Now, talking about gold, that has gone from 1900 now down to, looks like it's approaching 1200, 1210 or whatever it was this morning. You've got silver getting beaten up. The hard assets are getting hammered, but
they're down below their production costs.
They're down below their production costs. So
which
I think
a lot of questions.
Yeah, it raises a lot of questions, and I think some of the questions are, there's been plenty of talk about, is the price of gold being manipulated, and there's some pretty good evidence there is. What's interesting is that it may indeed be China who's manipulating it down at the same time that China is trying to buy all the gold they can and produce all the gold they can. So we've seen a big shift in gold that is going to the Far East. And so I think gold is an asset that has withstood the test of time. Fiat currencies have always failed. But of course, people have such short-term outlook these days. They can't, and they've read so little history, and especially financial history, they can't imagine that. They can't imagine a world without the dollar. So, like I say, for my money, I like things where I don't have a counterparty, that yellow metal sitting in the safe deposit box or the hole in the ground or wherever I may have it gives me some comfort.
Many of our listeners, Doug, are concerned about the potential predatory actions that the government may or is likely to take in the future with precious metals. We had confiscation back in the 30s. I'm not suggesting I personally think that will ever happen, but could you share your sense of what form that may come, or whether you anticipate it, or what your thinking is on it?
Well, I think that I'm with you. I don't think there'll be a confiscation, because I don't think most people have a lot of gold. I don't know how much they would confiscate. Certainly they could put it they could try to aggressively tax it, as you try to change your gold into, usable goods and services. So it probably would come in that form. But I'm of the belief the sitting duck sitting there for the government is 401k plans and IRAs.
Exactly.
They have a record of them. There's no way to hide them, and it would be very easy for them to change the rules on that and say, listen, if you want the preferred tax treatment on this, your money has to be completely in, government bonds. You can make almost perpetual government bonds or 100-year bonds or whatever the case may be, and suddenly everybody would have to convert their assets into government debt. That's the confiscation that I see coming. I don't think the government. Ben Bernanke didn't believe gold was money. I doubt Janet Yellen does. I don't think anybody. I think the the people who used to worry about gold, like the Paul Volckers of the world, and those kind of people that used to be in the White House are long gone.
Yep.
And so I think that I think they're going to go after the low-hanging fruit, and that's people's retirement accounts.
Every government that gets into troubles in fiat currency at some point, and I'll use a heavy word, confiscate the pension plans, the assets. Confiscate, they'll be taken control of, and if you, as you I believe correctly just pointed out, whether you keep them in government bonds, and therefore they're financing the government. It's almost preordained as your debt gets higher and higher, and to keep it going. So I think that's a good chance. Doug, we have to wrap. Any closing comments you want to share with our listeners in the way of financial repression, of what they should be doing or worrying about or thinking about?
Well, the other thing I would tell your listeners is that right now it is very, the government wants you to take chances. They want you to take risk. They want you to buy stocks. They want you to buy Alibaba and Apple. They'd love you to borrow money to do it. And I think this is absolutely, even though rates are low, I think it's absolutely the worst time to do that kind of thing. It's the worst time to speculate. It's hard if you haven't been in the stock market with your retirement funds. If you've watched it go by, you want to pull the trigger, but please try not to pull the trigger and wait for the eventual crash to come, because it is definitely coming, and you don't want to be caught in it.
Now, can you share with our listeners where they could learn more about your work, your writings, and things you're involved with?
Well, go to Casey Research. That's casey.com. I'm there quite a bit. Also, I'm a board of director at the Mises Institute of Canada. So if you go to mises.ca, my work appears there. But primarily my work's at Casey. So check out, and there's plenty of great commentary and plenty of great advice at Casey Research.
Appreciate your time, appreciate your comments, and we'll talk again.
All righty. Thank you so much, Gordon.
Thank you very much for coming. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.